Hi, I'm Mark Rossano, founder and CEO of C6 Capital Holdings, coming to you from Primary Vision Network. So before we start, we'd like to remind you, please like, share, subscribe. If you find this helpful, anything that you can do to help us spread the word would be greatly appreciated. And as always, please feel free to leave comments in the comment section, or you can reach out to me on Twitter. So we're going to have our normal 3 segments of the EIA show. The first part is we're going to talk about how we had an oil draw, but are we going to get some more builds prior to kind of the beginning of the summer driving season? We want to talk about how distillates have continued to increase, but gasoline has kind of gone sideways, similar to what we were looking at. And then that's going to lead us into how demand has slowed and how there's a mixture of, obviously, shoulder season, because we're not quite into summer driving, but it's still kind of cold out. And so you're in this weird middle point, or the shoulder season here. And then we want to look at some of those economic pressures that are also weighing on it and how that's really going to take center stage as we go into summer driving, or what we think is going to be a bit weaker on the summer driving side. And then we're in segment 3, we're going to go to the physical crude market, and we're going to show on how, things have weakened a bit. And then we also want to look at how Saudi Arabia has increased official selling prices and why they're raising prices even as the market weakens, and some of the different impacts of that and why they would do it, because again, there's some pieces within it. So with that being said, we're going to jump right into our discussion. And I wanted to start with the supply adjustment. So I know that this has become a very big thing. I'm not quite sure why it's become such a big thing. So you have to think about its statistics, right? So we're dealing with a survey, and there's only so much information you can get. And there's 3 key reasons why the size has become so wonky. And one is exports. So there is a timing delay on paperwork, on when it leaves the EEZ, and the lightering versus how you're lightering, when is it deemed an export. So there is a certain amount of export. And then the same thing is on the import side. There's delays on the filings. There's delays on when this is recognized. And it's not a surprise to see that when the U.S. started to export, you started to get more variation. And it should be of no surprise that as our exports have grown, especially during the COVID period and then beyond, especially now with Russia, Ukraine creating the European sanctions, it's gotten even crazier. Now, the other key piece is blending. So also when you're importing, and also when you look at just what the U.S. is producing, there's also blending going on. And the problem is when does it get picked up? Is it at the export point? Is it at the import point? Or is it at when it's recognized in the tank? Because imports, exports from the EIA perspective is collected monthly. So there's a certain amount of unknown that's going to happen, and which is why, for those that watch us all the way to segment 3, we talk so much about the exports and the timing delays that can happen with that, just because, again, like the U.S. physically does not have the capacity to export 5.4 million barrels a day. It's physically impossible, but yet that was the number that was reported 2 weeks ago, and now this week is lower at something about 3.3. Again, both of those are wrong, but there's a certain amount of balancing. So is it, at what point are you getting picked up? And that's why the number has come back down, because there's been some clearing. It's now being recognized in storage versus being on so you had boats that have left, you had blending that is now being tallied at the tank. So that's why we talk so much about the trend, about the 4-week rolling average, because all statistical data is going to be imperfect. For those that watch the Econ show, we talk about diffusion indexes, we talk about surveys. Each one of them is going to be wrong to a certain degree, but it's going to give you an idea of trend. Like we were talking about PMI. The Chinese PMI data exploded, but what were the drivers? Is there sustainability in that? Is there sustainable expansion? Yes. Is there sustainable expansion at that level? No. So again, there's different pieces, which is why. And then the other component is, not so much on the EIA side, but in other economic data, the responses have been terrible. People are responding to the surveys less and less, so you get a much bigger error margin. So again, this is why we talk so much about trend and what are the indicators, and why we talk so much about AIS transponders and what the ships are doing, because the ships don't lie. When they're actually tallied will vary, but I can tell you that there's, let's just say 10 ships coming from West Africa into the Gulf of Mexico. We know that. When those 10 ships will actually unload, or how many of them will actually hit the U.S., I can tell you when they get to the U.S. coast, where they're sitting. And I can also see when they unload, but when that gets calculated into the numbers can vary. And again, we're not talking about 6 weeks. It could be 1, 2, maybe 3 weeks in terms of when that starts to show up. And that's, again, why there's kind of this catch-all of the supply adjustment, because you're going to have a number that is unaccounted for because it hasn't gotten into the point where it can be calculated. And then the moment it can be calculated, you can see that the adjustment can drop because it's going to be picked up in their calculation, which is obviously going to be heavily driven by storage. So that's my rant on that. Now, when we look to the total oil product stocks, you can see that the surplus widened from 36 to 38.7. Total crude stocks, land and floating, surplus widened from 33.3 to 40.9. Total oil product stockpiles, the deficit, it flipped to a deficit from a surplus of 2.8 to 2.3. So realistically, as we've been saying, the product stockpiles are going to follow along. But one of the things is you can see that there's normally that draw. We just see it leveling off and being a bit above and not following that drop down. Now, that's going to be the case as we get some of these new, some of the refiners coming back online, new refiners coming online. Kuwait is bringing on, started operations of the second phase of the Al Zour refinery project. The Al Zour is set to be able to process 615,000 barrels a day once at full capacity. Again, just seeing more of this come on, which will take some of that crude out of stocks, but again, it'll just put more into stockpiles. So it's just, when you look at it, you're starting to see a bit of that trend higher when you look at the global backdrop. Again, the U.S. had a small draw. Well, we will get some additional draws in some other areas this week, but the trend at this point, especially because we're in March, we're in the shoulder season, we will start to see some of those builds on the crude side as we get more refiners that are coming down for maintenance. Now, cargoes of Russian ESPO crude are being bought up pretty quickly by China and India that had previously stayed on the sidelines, which again is starting to come up. We're starting to see a little bit of a bid in Urals. Again, it's still at about 49.50, almost half the price. But as we said last week and the week before, the range for Brent is about 81 to 86. When we broke 86, we said, look, this is too much. Now, as we're at 82.52, you'd be looking to cover that short and go long, because again, we're stuck in a range and it's not going to go anywhere from this point. When we look at land storage, here you can see that the surplus narrowed from 10.9 to 8.7. West of Suez, the surplus narrowed from 18.3 to 15.9. East of Suez, the deficit narrowed slightly from 7.5 to 7.1. And that's because we have a surge of oil in transit. So again, oil in transit is not going to be in land storage, and it's also not going to be in floating storage. It's going to be in that in between. And as we've had some renewed purchases of Russian crude, you're getting some of those additional movements. We've had a little bit of a slowdown on Angolan purchases, but Nigeria has been fairly stable. And some of those purchases will be coming into both, Europe and the U.S. And now on the other side, when we look at the Middle East, it's important to look at what's happening with the UAE and what's happening with Iraq. And that's something that we're going to talk more about in segment 3. So when we look at floating storage, the surplus narrowed from 18.2 to 11.6. West of Suez, the deficit narrowed from 7.3 to 4.7. And then in east of Suez, the surplus narrowed from 18 to 17.2. So again, it's just that balancing act and where some of these movements are, but we do see a little bit of an increase in floating storage. And you can see just in total, it's going to be similar to 2022. We're not going to set these new crazy records like we did in 2020 and 2021. It's going to be fairly, sideways, if you will. And the question is going to be how quickly Angola can clear, because if they can't clear some of those April cargoes, we'll start to see a little bit of the pickup on the west of Suez side. And then the Middle East is going to be a key one to watch, as obviously OSPs have gone up by Saudi, but the other countries actually left things flat. Crude stock build. So we had a small draw of total flows. When we look at the underlying number, we had a draw of 1.69. When you look at the underlying volumes, so again, it's still 37.8 million above the 5-year average. When you look at the different levels, there were draws everywhere except for Pad 3. Pad 3 had a build of 2.62 million, and a little bit of, again, that build is a bit of that makeup between imports, exports, and that's where you typically kind of get a little bit of that catch-all is in Pad 3, because that's where we've also seen a lot of blending, where the U.S. has been importing some of the heavy fuel oils, as well as blending some of that naphtha and condensate that's coming off of these wells. So some of those pieces in between. Now, when we look at the underlying flows in Pad 3, you can see that it's still elevated, but as we were saying, the rate of change is actually fairly normal. It's just we're starting from a higher level, and we don't see that adjusting, like just based on where refinery utilization rates are. Utilization rates were up slightly by 0.2, so from 85.8 to 86, but still, again, very comfortable in terms of flows. Cushing, small dip, but you can see just looking at other areas, this is usually where we have a small dip. And then we typically continue some of these builds through the end of March. And again, the rate of change is going to be fairly flat. We're not going to get this huge surge of Cushing like we did in other years. It's going to be fairly stable, and it's going to put us at a very average number when you look at it going back to 2004. Runs, as you can see here, the actual run rate was up 0.2. Actual 1,000 barrels per day was down 11,000. So again, it's just a matter of how it's being utilized. Pad 1 came down a bit, Pad 2 up a bit. There's really not too much to say here, just because it's very seasonally normal. You can see against the 5-year average, it's a little bit higher, but that's actually because there were some sizable issues that happened when you look at 2021, when you had that massive drop. And then when you look at 2018, you had another drop. So realistically, we're still below normal. When you take out those two big outliers, we're still at the lower end, but nothing crazy. And you can see it's just flatlining, where typically you're starting higher and then you fall to this number. We've just been here because some maintenance was pulled forward. You had some of those different pickups. So really nothing too crazy when you're looking at underlying flows. Imports were up slightly, 62,000 barrels a day. That's still 500,000 below the 5-year average. And as we've been talking about, it's all about shifts. We had said that Pad 2 was going to have a sizable increase as the TC pipeline was fixed post the leak. We've seen some additional flows, and again, that's just kind of getting back to normal, which for Pad 2 is going to be above the 5-year, but fairly normal versus last year, because when you look at last year, it's actually slightly down. So we still have 214,000 barrels a day coming into Pad 2. That'll pare back a touch, but still be fairly elevated. And then Pad 3, again, that back and forth. And then Pad 5 remaining lumpy, which is some of the key pieces that we've been talking about. When you look at Pad 3, again, we thought it was going to have a little bit of a bounce. You could see it had a little bit of a bounce, then a little bit of a drop, but still fairly in line. It's going to be below the 5-year average. It's going to, again, move a bit higher, but it's just a matter of when they get loaded up. It's not going to be above the 5-year. It's going to stay a little bit above here, but again, still well within the lower end of the cloud. Pad 2, again, above the 5-year average, going to stay above the 5-year average, but when you look at some of the shifts, Pad 2 had a very sizable 2021 and a 2022. So it's going to be tough comps, but there's going to be enough to be above the 5-year, but really not enough to make new seasonally adjusted highs. And realistically, as we maintain some of these current throughputs and those imports, we're going to stay at the higher end of this level. And then, which will then become the 5-year average, if you kind of think of it from that perspective. Implied demand had the drop that we were talking about. And gasoline came down 550,000 barrels a day. Distillate was the surprise. So we talked about gasoline. We expected it to come in. We said it was going to be about 8.7. Instead, it came in at about 8.56. It's still too high. You know, we're still at about 8.4 million barrels a day. So we will see some of that drop, but it's just starting to balance out. As we were saying, you had February break. You had a lot of inclement weather coming up for those that are in Texas and the South. You have spring break coming up. That'll put a little bit of a bid. So we should have 1 or 2 more weeks that's a bit lower. Then we should get a little bit of a bump. And the question is, does the bump go to 8.6, 8.7? If it does, it's still going to be below normal, and that's what we'll talk about in a minute. And then the distillate side, you can see that was a sizable drop. We did get a little bit of an increase in trucking. It's still very slow. We just had a recent bankruptcy. So again, the trucking side is horrendous. It's gotten a little bit colder versus normal, but we're in March. So colder versus normal, it's, if you're in January and February and you're colder versus normal in the Northeast, instead of being 35, you're 28, or 37, you're 20, 30, 29. This, instead of being mid 50s, you're low 50s. And it's still, it's enough to keep people cold, but it's not enough to keep the heat, blaring. So again, you're still losing some of that heating side. There was a bit of a makeup number in the jet fuel side. Again, it's going to fall back to the average that we talked about, 1.45, 1.55. Resid just dropped back down. Propane, propylene coming in at 221,000 barrels, 109,000 barrels a day down. But again, it's still, the heating is an issue on the propane side. We still have strong exports, and that will continue. Now, when we look at gasoline implied demand, you can see that there was the drop back down to 2013, 2014 levels. Obviously, 2021 was also lower. But realistically, it's just when you look at the seasonality, and that's why we try to come back always to where should we be. And you can see that after you get a nice little pop, you normally get a drop, and then you get another increase. And that second increase is the broader spring break. That's, you have colleges that have spring break. You have the South that goes on spring break. So it's just, in the North, we have February break. So here you have, winter break, spring break coming up, then you're going to have Easter. And so you're going to have some of these bumps, but you're still well below where we should be. And a lot of that is just the changing driving patterns, the more fuel efficient cars, finally kind of catching up as people cycle out of the older vehicles. And then obviously you have the underlying weight of the economic condition. Now, when we look at total crude oil here, you can see again, across all of them, they're just fairly normal. Nothing bullish or bearish realistically. We're just kind of here and at these current levels. When we look at everything with product and floating and oil storage, we're right where we were in 2020, 2019, again, fairly normal. And you can see that there's a bit of a flat line. And then from this point, we typically go flat and then start to see a bit of an accelerated drop. And it's no surprise that happens during summer season and driving season. So again, very normal at this point in time, seasonally speaking. Days of supply, again, nothing too crazy here. Gasoline storage, as we've been saying, going a bit sideways. It's obviously still coming down against the rate of change, similar to 2022, similar to 2015. But you can see it's just we normally have these sizable numbers and then a steep drop. And our whole thing is we're just not going to get a big increase because we had run rates from the refiner side come down fairly quickly. And we just don't have a lot of demand. So you got to get that sideways move, which is going to bring us more in line. And in the next segment, we narrow it to just the last 10 years. So you get an idea of where we are versus historics on a closer scale. Distillate, another counter-seasonal build, getting very close to the 29-year average, but still obviously on the lower end, but getting closer to normal. Jet had a bit of a drop. But still, it's just that balance between distillate and kerosene, so nothing too crazy there. And then on the WTI Crude Futures, still in that contango. Obviously, we've had a bit of a drop following some of the bigger increases, and it's going to play back and forth. And that's what we've been talking about when we look at some of the flows. The Fed came out a bit more hawkish than I guess the market was expecting. Realistically, if you've been following the econ show, the Fed did kind of what we expected them to do, so this wasn't a huge surprise. But we didn't really understand why there was a huge increase in crude pricing outside of just the general technicals. So we're just using technical trading right now to look at this, because it's whatever narrative kind of picks up. As we get closer to 81, the narrative picks up on the reopening. You have the China, you have, that, then we run back up. And then as we get closer to 86, 87 on the Brent side, all of a sudden it's, the economy's struggling, inflation, and then you come back down. So it's just, we've been in the same range for 6 months. And right now there's really nothing to break us out of it at this point in time, which is why we're going to stay fairly range bound. Floating storage, pretty close to average. We see a little bit more builds just given what's floating our way. It's just going to be a matter of, again, when it goes from floating storage to onshore. And that's going to be what we pay attention to. And again, a driver for some of those adjustment numbers. So that's what we have for you in segment 1. Segment 2, we're going to go deeper into demand and some of the key drivers in that region.